So let's talk about money and banking. This is a long slideshow, so if you need to take a break halfway through or multiple breaks, that's fine. I'm going to do it all as one video for convenience sake, but please know that you can pause and rewind as you need to. So for money and banking, the first thing that we need to know about money and banking is that money did not always exist. Before we had money, early people would use a system called bartering. Bartering means to trade without using money. So the synonym for barter would be trade, to trade things, just like you do at lunch. Sometimes you will want to trade a bag of chips for a cookie, and that's called bartering. You're bartering in modern times. The problems with bartering, though, is that when you don't have money and you have to carry things around to trade, that can get difficult. So, for instance, if you were going to go to the market and you wanted to buy a bushel of wheat and you would trade that wheat for a goat because you were a farmer, it's kind of hard to carry around a goat all the time. So, carrying a goat isn't convenient. And the other thing about bartering is, how do you know how much of a goat is going to be worth a bag of wheat? You don't. Both people have to agree. Both people have to be interested in what each other has in order for the bartering to work. It's also, how do you find the value? Like, what's the actual value of a bag of wheat versus a goat? It's hard to tell the value. So bartering was a difficult system that worked for a long time, but it was complicated. And so eventually civilizations invented money. So the early civilizations of Mesopotamia, Egypt, India, China, all of those invented currency. Currency was a way to buy and sell things without trading objects or trading items or trading animals. So when they invented money, when they invented currency, it had to meet certain criteria or certain rules that made it easier. The first rule was that it had to be easy to carry. Unlike a goat, which is not easy to carry, money is easy to carry. You can put it in your pocket, you can carry it around. It's not too heavy, things like that. It also mustn't be easy to counterfeit. Counterfeit means that you can fake it by making, pretend money and passing it off as real. So you can't really do that with a goat because you can just go to another farmer's lot and get another goat, and there you have some more money. So money has to be not easily counterfeitable. It has to be, not something that the average person can just make. The next thing is that it must hold its value. A $10 bill in our society holds its value. In 5 weeks from now, a $10 bill is still going to be worth $10. But in the old days of bartering, a goat doesn't hold its value. A young goat is more expensive than an old rickety goat. Nobody wants an old rickety goat. So a goat doesn't hold its value for long term, whereas a $20 bill or a $100 bill in our society does. It's going to be worth that, 5 years from now. It's going to still be worth that amount of money. Not a goat. When a goat gets old, the other thing is that money must be divisible. Divisible means that you can divide it up. So like, let's say you go in and buy something for $10, you can get your change. Like if it doesn't cost $10, you can get $5 back. It's divisible. It means you can divide it up, and the money is in all different denominations, ones, fives, tens, 20s. A goat, not divisible. You can't just be like, oh, your bag of wheat is worth half a goat. Here's half a goat. That's not how it works. You can't just be dividing up goats all the time. It's savage. It's not okay. So invention of currency made it a little bit easier. Now, I will have a couple of videos for you to watch about bartering. Here's a couple. You can go into the PowerPoint, but I might link them also into Google Classroom. Then we're going to go into a section called money. What is money and the history of money? There's a lot of videos this week that I think would be helpful for you to watch. So I will link them in so you can go in tomorrow and watch them. Okay. The next thing is, how is money made? Currency is the money in a given place. Excuse me. So in America, we use the American dollar. In Canada, they use the Canadian dollar. Mexico uses the peso. Japan uses the yen. So we make money in different countries, and it's the act of making money is called minting it. So when you mint something, you're making it, but it's just regards to money. And there's a video that you can show about how money is made. There are actually 4 videos about how money is made. So we'll take a look at those in the next couple of days. There's also some fun little time for a laugh videos, and I will try to post those in one place. You know me, and you know I love kids snippets. So these kind of relate to economics, but you're going to have to pick up why they relate to economics. They're loosely tied, but I'll put those in a place for you guys to see them. All right, let's take a look. Now, why should you put your money in the bank? Some people think, well, if I just keep money in my house, like it's going to be safe, and why would I put it in the bank? Well, there's 2 big reasons why you should put your money in the bank. One is that it's protected, it's insured. If your money is in your house and your house burns down, guess what you don't have? Your money. If you put your money in the bank is got something called insurance, and insurance means protection from loss. So if the bank burns down, you're going to get your money back because the FDIC is going to cover the amount of money that you had in the bank. So it's safer in the bank because if the bank gets robbed, or if the bank a meteor hits the bank, or a giant tornado and the bank is completely ruined, that bank is insured and you'll get your money back. Whereas your house, it'd be hard to prove to say, well, you know, I did have $1 million under my mattress when the tornado hit, officer. Yeah, not as much easy to prove. So the first reason you put your money in the bank is because it's insured and it's protected there. The second reason you would put your money in the bank is because it earns something called interest. So interest is money earned for using your money. So when you put your money in the bank, you not only get your money back, but you get a little bit of extra that the bank pays you to use your money. So 2 reasons you put your money in the bank. 1 is it's safer there because it has insurance. 2, it earns interest. You can actually earn more money by putting your money in the bank. And we'll talk about why in a couple of minutes. So when you put money into the bank, that's called a deposit. When you take money out of the bank, that's called a withdrawal. Okay. There's another video, a kid snippet video about banks. You can go in and watch that this week. I'll put a bunch of funny videos up. So how does a bank work? I told you that this week is heavy in videos, and so we're going to spread those out over the week, but there's a great video. This one here is informational, but it's 3 minutes and 8 seconds. It's worth it because you can kind of see how the money is recirculated within the economy. So when you put your money in the bank, it doesn't just stay there. It's not like they take your money and then they go into the back room and put it in a little bin that says Linda Walsh's money. And then the next time I come back into the bank, they go back into the back and they pick out my money. That's not how it works. When you put your money in the bank, that money is going somewhere else. You are not going to get your same money back. Okay. So what it does is the bank hands your money out. The next person that comes into the bank comes in to borrow some money and takes your money with them. But the bank keeps track of how much you had in the bank. So the bank pays you to use your money because when we buy expensive items, we don't have the money to buy something like a car or to buy something like a house or a boat or to pay for college or to pay for a wedding. So when people need to buy expensive things that they don't have the cash lying around, they actually take out a loan or they borrow money from the bank. And the bank says, oh, I see you're an honest person. I see that I can trust you to pay me back. I'm going to lend you this money for a car. And then the bank charges interest to that person. So when you borrow money from the bank, you have to pay the bank more than you borrowed. And when you put your money in the bank actually pays you to use their money. That's because your money is going to someone else's loan. And if you watch the videos, it explains it really, really, really well. So basically, the bank is charging people to borrow money, and they're earning some extra money. And then when you put your money in the bank is paying you to use your money. So it's a recycling system. The bank is a recycling system. So let's take a look. Let's go to the next thing. So what is a loan? We talked about it a little bit. When you don't have enough money to pay for a big cost item, like a car, college, a house, a wedding. That means you borrow money from the bank and you promise them you're going to pay it back and you're going to pay them back extra. And they're going to make money off of you. So each month you send them a loan payment. Sometimes it's called a loan. A loan for a house is called a mortgage. So you pay back the bank every month and the bank leaves you alone. If you don't pay the bank back, then they can actually seize your property. They can take back your house. They can take back your car because you did not pay it back. Okay. So you pay them back with something called interest, the extra money that you add just to borrow that money. Okay. Alrighty, let's do this. Bad credit. So everyone earns their own reputation in life. Like there's people you don't like to hang out with because they have a bad reputation. You don't hang out with kids that are going to get you in trouble for the most part, if you're smart. So we all have a reputation, and it's how much people trust us. So when you steal and you lie or you don't tell the truth and people can't believe you because you're constantly lying or you're taking things from them or you're not being nice, you're not trusted. Your reputation is that no one trusts you. It's the same thing when you get older and you need to deal with the money world. The banks keep track of how trustworthy you are. And you can't do something like buy a car or buy a house if you don't have a trustworthy reputation. And in the banking world, we call that credit. Do you have good credit or do you have bad credit? So now to have good credit, you need to have a record that you pay your bills. When you pay your bills on time, that helps you get good credit. When you pay the bank back when you borrow money, that gives you good credit. When you pay your credit cards every month and they can trust you to borrow that money, then you can get good credit. If you don't do those things, then you get something called bad credit. And when you have bad credit, the bank really doesn't want to have anything to do with you. Or if they do want to have something to do with you, like give you a loan, they're going to charge you a lot more interest because you're not trustworthy than someone who's very trustworthy. They'll say, sure, you can borrow this money and I'll give you a low interest rate because I know you're going to pay me back. So when you get older, it's very important to have a good reputation with your money, spending it wisely and paying your bills. Because when you get bad credit, you have a lot less opportunity. Getting a car is going to be really hard for you to do. Getting a house is going to be really hard for you to do. Paying for a wedding or paying for college is going to be really hard to do. So you need to keep mindful of that so that when you get older, you're paying your bills and you're keeping good credit, which means you have a good money reputation with the banks. So 2 ways of putting money in the banks. You can put your money in checking account or you can put your money into a savings account. Banks offer both. When you put your money into a checking account, this is when you're going to spend the money on things. So it's kind of like you're putting your money into the bank on a temporary basis because you get paid on a Friday and then that week you're going to pay some bills. You're going to pay your rent. You're going to pay your car loan. You're going to pay for food, groceries. You're going to pay for gas in your car and insurance, things like that. So to have a checking account means that your paycheck goes in, but then you're paying bills and you're paying that money out. So it's kind of like an in and out account. You can write checks, although nowadays most people do online banking. And so the bank sends directly to who you're paying a bill to. But that checking account is really money going in and money going out. Whereas a savings account is a little bit for longer term. When you put your money into savings, the bank is paying you a little bit of interest to keep it in the bank. And the longer you keep it in the bank, the more interest that you do earn. And different savings accounts have different levels of interest. So be smart when you get older about putting your money into a savings account that's going to earn good interest. And if you can put money into a savings account and not use it, the bank appreciates that. So they give you a little bit more interest. Okay. So you should always have money in a savings account for a rainy day. A rainy day means it's just kind of a figure of speech we use that says for an emergency. So when you put your money in from your paycheck and you're constantly just paying your bills and you have nothing left over in your savings account, you're setting yourself up for some trouble. Because what happens if you lose your job? What happens if you temporarily get sick and need to stay home from work? What happens if someone in your family has a medical emergency that's going to cost a little bit of money? Or your dog needs an operation. Meet the $1 million dog here. Constant operations, huh? Yeah, you're worth every penny. But in order to be able to pay those unexpected things, you should have an emergency fund in savings and not just have a paycheck where you're spending and saving and spending and spending and earning and spending and earning. You want to actually put something aside to save for an emergency. Okay, that's very important. Stock market is one way that you can invest your money. So if you have extra money after paying your bills and you have already money in the savings account where it's safe, then a stock market is something where you can put your money in and invest it in different companies. So basically, we're not going to talk too much about the stock market, but basically what it means is you find a company that you really think is going to be successful. And so you take some of your money and you give it to that company and you say, I'm giving you some of my money because I know you're going to use it wisely and you are going to become more valuable. And if the company does well in the economy, you make money. But if the company doesn't do well, you lose money. So it's kind of like a bargain. You know, it's you're taking a chance when you're putting money in the stock market, which is why a lot of people don't do it if they don't have the extra money. But the stock market is really depends on how well the companies are doing. So if you invest in Apple, and Apple does very well, you can make some money at it. But if something happens and Apple loses its value, you also lose your money. So it's a little bit of a chance. There's some videos here you can watch about the stock market just to get a little bit more interested in it. All right, so to review, we did not always have money and we used a system called bartering. Bartering means to trade. There are some problems with bartering. One, it's hard to carry around a goat all the time. And so when you don't have money and you're trading things by carrying around cows and goats and bags of grain, it's not a very good system. Also, it's not a good system because how do you know the value of a goat? You really don't. Also, it's not divisible. You can't just be dividing up a goat and say, I'll pay you 1/4 of a goat for that bag of grain. No, we shouldn't be dividing up goats. So nowadays we still do barter. Like some people trade baseball cards or some people, trade services. Some people will say, oh, I'll cut your hair because they're a hairdresser, they cut your hair in exchange for mowing their lawn. That would be bartering. You barter at lunchtime. But the problem is both people need to be interested in the trade in order for it to work. Nobody wants to trade a bag of Takis for an apple. Well, most people don't. So that's not a trade that will work. So there's problems with bartering, which is why currency was invented. So we use the United States dollar, the American dollar in our country. That's our currency, but every country has a different currency. Currency should be easy to carry. It should be easily divisible, and it should be easy to, it should hold its value. It should stay the same value over a long period of time. All right, so 2 reasons you should put money in a bank. 1, it's safer. If there's an asteroid that comes crashing down to Earth and ruins your bank is insured by the FDIC, so you'll get your money back. Whereas if your house is destroyed, it's hard to prove that you had money in your house, so you don't get it back. The second reason is because it earns something called interest. That's extra money for being able to use your money. What was that? You're high maintenance. You're high maintenance. All right, so insurance is protection from loss. Interest is the money that the bank pays you to use your money, or if you borrow money from the bank, interest is what you pay the bank back in order to borrow the money. A loan is borrowing money from a bank for something like a big price item like a car or a wedding or college, or a house, although that's called a mortgage when you get out a mortgage for your house. Let's see, good credit. You want to have good credit so the banks trust you and that they will lend you money and you can get a loan for cars or cars, houses, weddings, things like that. And you don't want bad credit. You get bad credit by not paying your bills on time and not being trustworthy with money. Deposit means to put money into the bank, and withdrawal means to take money out of the bank. Now, that's a super fast kind of description about money and banking. Tomorrow I will go in and have you watch some of the videos so that you can see from a different perspective what those things are. But I think that gives you a good idea to be ready for your quiz. All right, thanks for learning about money and banking today.